webinar series where we talk to various industry experts about various aspects of personal finance and investment and various investment products. And I'm Gaurav, your host for today's session. Before we start the session, I will just quickly introduce Moneyfy to all our viewers. So Moneyfy is a complete investment app which enables all our customers to plan their investment, insurance, and financing needs in one single app. And we also have some interesting products along with mutual funds like corporate fixed deposits and NPS to offer complete financial solutions. Recently, we also introduced a direct equity investment through small case. So please download our app and you can start your investment journey through the Moneyfy app. Now, in our last webinar, we had talked about investing in equities through small cases. And today we are going to talk about investing in companies in the digital space with the product from Tata AMC, which is Tata Nifty India Digital Exchange Traded Fund of Fund. And to talk on the same, we have with us Ms. Shaily Gang. Shaily is the head of products at Tata Asset Management, and she has over 17 years of experience in banking and wealth management. Prior to Tata Asset Management, she has also worked with institutions like ICICI Bank and Royal Bank of Scotland. So Shaily, a warm welcome to you on Moneyfy Mantra, and it's a pleasure to have you here.
Thanks, Gaurav. Thanks a lot. And thank you, everyone. It's a pleasure to be talking to all of you. So as Gaurav has set the context very well, that today our agenda is to talk about the digital ETF fund of fund. So I plan to spend the next 45 to 50 minutes divided into three parts. One is talking about the concept of digital and what digital actually means to us, and a little about what is an ETF. Very basic discussion on what ETF, because that's the platform, and then fund of fund is how is the fund of fund and ETF attached, and then towards the end I will speak about the portfolio briefly, which is the digital portfolio and how it is different from the digital fund. And the most common query that I have got till now is how this digital index is different from the Nifty IT index. So these are some of the things which I would like to cover. So I will just share my screen and we'll get going.
I would request all our viewers to post their questions in the chat window, and we will take it towards the end of the session.
So starting with the concept first. So before the concept, setting the context for how digital, the space of digital has grown. Of course, we all know that the IT spending or the digital spending has increased primarily in the last 2 years. But if you see and if you note, from the market capitalization basis, and this is the world's largest market cap companies that we are talking about, 2005 and come now 2022, if you were to see how they stack up, in 2005, only 1 out of 8 largest market cap companies or companies by largest market cap, there was only 1 out of 8 which was a tech company. Come 2022, you have 6 out of 8 companies which are tech companies, the likes of Apple, Microsoft, Google, which is Alphabet, Google, Amazon, Tesla, and Nvidia, which is into semiconductor business. So this is proof of the pudding, or proof of the pudding, saying that how the space, because finally the listed market space represents the economy, and that is reflecting this change, which is from 1 out of 8 tech companies to 6 out of 8 tech companies as the world's largest market cap companies stack or come together. If you were to talk, from the share price perspective. So we've picked up the period, let's say from 2012 to 2021. And if you compare the share prices on a CAGR basis over this period, you would realize that the physical business companies, or the physical offerings, which are the likes of Walmart, Coca-Cola, their share price CAGR has been in the range of 5 to 10%, whereas the share price of the digital offerings, which is the likes of your OTT offering, which is Netflix, Amazon, which is the primary e-commerce offering, Facebook, Google, they're all more than 25%, with Netflix being at more than 50%. So that's the share price CAGR growth which we see in the happening in the physical offerings versus the digital offerings. Now, how are these digital offerings different? So one, of course, is that digital provides a fillip. The digital space or the digital platform provides a fillip to the physical business in many cases. For example, you have, let's say, Nykaa, you have multiple brands which are there, but Nykaa has become an aggregator platform where 3,000 to 4,000 brands have come together, and with convenience and faster and wider reach, the distribution is happening or the revenue is getting generated. So basically, the digital edge or the digital platform is giving an edge and furthering the business of the physical entity. So that's the role which digital is playing. Basically, it's permissionless. The in erstwhile there are labor and capital. These are the factors which were very, very famous, and labor being the first one. But there you need permission. You need permission for labor. For some, you need to go to someone and ask them to work for you. If somebody has to lend you something on capital, then you need to go to someone and they need to lend you that. So it's all permission based. But this digital space is something which is permissionless. Anybody who has an idea can further the idea, can scale up that idea using a digital platform, and that's the permissionless thing. And this is very well put, of course, by Mr. Naval Ravikant in his book, and this fits so well, into this space that for coding or for digital, for going digital, you don't need permission. It's permissionless leverage. It's a permissionless leverage that is being offered, and that's the benefit which digital businesses offer. As I said, in some cases digital businesses are supporting, like if you see the growth of online food services. So outside food consumption, out of home food consumption has always been there, but with this online delivery, that has been given a further thrust, and the growth rates are phenomenal. Of course, there was a dip in that growth rate because of the COVID impact, but more than 30% CAGR for the next 10 years is what is quoted by most of the reports, and that's a reasonable amount of number growth that we can see on this online food services. 2016 to 18 and 19, of course, it saw a humongous 3-digit growth, of 148%. But now, for the next 10 years, the CAGR quoted is about 30% for the online food delivery. On the other hand, if you see, the OTT platform has completely kind of made the traditional TV and cinema degrown. So they have degrown. So in some cases, it has helped the furthering of the business, but in this case, OTTs have made or have led to degrowth of traditional TV, cinema, podcast, video games, and some of these other segments. Viewer digital segments, and OTT has taken over on a large basis. So it's displaced in this manner. These are some of the numbers, and some of the data, which is basically, these are the drivers which have led to this kind of digital adoption, both by the consumers as well as by the merchants or the businesses. Both ends. If you look at the numbers, so between 2014 and 2020, the rise of internet subscribers, the growth rate is 225%. The data usage has gone up fourfold, as in the number is 4,500 percentage. That's the growth rate. Even the data tariffs have increased, and Wi-Fi tele-density. So the growth rates, are humongous in case of these drivers, and which has led to the adoption or better or faster adoption or digital adoption by consumers as well as by merchants. Now, digital is a very, very common word. People could use it in different manner. We want to, with this, slide here, I want to convey what does digital mean to us. And we also have a digital fund. It's an active mutual fund, which is done phenomenally well, quite well. And it has, the AUM is also garnered, and it still is seeing positive inflows month on month. That fund caters more to the digital enablers. And the list the stack which you see on the right hand side is what it, captures, which is IT services, cloud transformation, and some bit automation, robotics, and IoT. Now, IT services, so cloud transformation and IT services are the primary mainstay, are the mainstay of this, digital enabling space. Basically, if you see, globally, the hyperscalers, which are the people or the entities who own the, cloud spaces, which are the likes of Google, Azure, AWS. These are entities who have large large spaces, basically. And the act, or a lot of companies want to move, they want to migrate their data, their software, their infrastructure, all their workings to this space. And there are a lot of benefits why they want to do that. Of course, first is that costs come down, and and because of less electricity usage, or there is an ESG angle also to this. But primary reason, of course, is costs come down. And why, if the migration is seamless, and if the migration is done seamlessly, then there are a lot of benefits, in the other form also, in terms of innovation and better adoption, and and so on and so forth. So IT services and Indian companies, the likes of Infosys, TCS, HCL Tech, Tech Mahindra, these are the companies who are good system integrators to help companies, other segments, move their wares from local servers to this cloud servers. So we are not innovators in terms of owning the space like how a Google would do, but we are very good in terms of integrating all, and migration. Integrate first, migrating, and then integrating all the softwares and the apps and everything to the cloud, and for which, as I said, there are a humongous amount of benefits, primary being the cost reduction. Now, that's the primary, presence of this digital enablers, and our fund, digital active fund, which is there, that captures a lot of this space. But on the other hand, you have these digital change agents where companies are present. Many of them are now getting listed. The likes of Zomato, the likes of Nykaa, Policy Bazaar, and you will soon have companies, which will be, let's say, a farm easy, let's say, a e-commerce company on the pharma side, which will be providing medicines and and related stuff, or EOTC. Or you could have a education company, a e-education edtech company getting listed. So these are the kinds of, you already have some fintech companies, like the likes of Policy Bazaar and Paytm. So this is the space which, this ETF will capture more. It will also have a representation of the digital enablers. But over a period, the idea, as more listings happen, and as the digital change agents get more representation in the economy and also reflect in the markets by way of listings, the share of these digital change agents, the likes of these companies which I just mentioned, would tend to go higher in the digital index, which we have co-created, or which we have created along with NSE. That's why you see the name as Nifty India Digital Index. So in this index, then this share would tend to go up. And obviously, because we are an ETF and a fund of fund, or a passive product based on this index, our fund share towards these digital change agents would also go up. Um, this is just a pictorial representation of those companies. So you can see the logo of Zomato, because now with effective from 31st, which is tomorrow, we will have 4 names added to this digital index: Zomato, Nykaa, Policy Bazaar, and Paytm. So these are the 4 names which will get added. And as more listings happen on a monthly basis, they will be, that's part of the methodology. So on a monthly basis, they'll be screened, and whichever are eligible, they will get added. We'll come to the methodology also in a bit. Just to give you a sense of what is this food tech, health tech, e-gross or q-commerce, what is about all of this. So first segment where I would want to cover is this online food delivery. Here it's a duopoly, of course, Zomato and Swiggy, but out of home food consumption, that has increased, and it is slated to increase and reach up to 21% of the overall overall food consumption. So out of home food consumption is expected to have a CAGR of 15% over the next 10 years, and it is supposed to reach about 20% of the overall food consumption. Now, within this out of home food consumption, currently the online food delivery market is just 8 to 9%, which is expected to again reach about 20%. So within out of home food consumption, which is supposed to grow, within that, the online food delivery is also supposed to grow and reach at about 20%. Here, the growth of this online food delivery is expected at about 30% CAGR for the next 10 years. There are various reasons why this is happening. So the primary reason why out of home food consumption is happening is because you see a lot of internet penetration, you see nuclear families, you see rise of incomes, and primarily you are seeing the growth of or workforce participation, having a lot of women participating. So that's the overall change which is happening in the ecosystem and consumer behavior, and that is leading to online growth of online food consumption. uh, Online delivery growth is also, of course, these factors are there, but as you see, you have now availability of reasonable and good quality standard quick service restaurants which are available. So that is also aiding the growth of online food delivery. Plus, you have cloud kitchen which is emerging. Yes, cloud kitchens are undergoing a lot of format changes, but that's one area in the metros at least which is again aiding the growth of online food delivery. Plus, the quick service restaurants, the likes of Burger King and KFC, which are good standard and good quality, they have expanded very well to the tier 2 and the tier 3 cities. And they are now available, they're now covering 500 cities in India. So this is the path that we see, that is kind of slated for the growth of online food delivery. If you compare India market to US and China, India right now, out of home food consumption is just 10% vis-a-vis China and US, which are more than 50%. Within out of home food consumption, online food delivery is 9% in China, which is expected to go to 20%. But currently in China and US, that online food delivery share is already more than 30%. In fact, in case of China, it is already 50%. So that is the thing about the online food delivery. Of course, we covered emerging cloud kitchens. You can say the likes of Rebel Food, Biryani by Kilo. That one, of course, is a very, very focused. These are just examples, and how availability of some of these brands also aids the online food delivery. Quick commerce. Now, quick commerce is grocery delivery. I'm sure everybody's already heard about the likes of Zepto and Blinkit coming in. Zomato and Swiggy already have a very good delivery mechanism set up for their online food delivery, and they feel that if they were to adapt to this or align to this quick commerce of 15 minutes and 10 minutes, as good as cab hailing. Cab hailing is 10 minutes and 15 minutes of time or tat. So if because they have their delivery mechanisms ready, they are confident of getting into this quick commerce business and delivering and utilizing their current setup. And also, one thing which is helping, the likes of Zomatos and Swiggy, which are already into online food delivery, to come into to come into Q-commerce, which is the quick commerce, which is a grocery delivery, basically, is setting up of micro warehouses, into the closer to the point of delivery. And there they stock large ticket or high demand items, and some of these changes they are making, and they're optimizing the current setup. Quick commerce is just so basically grocery size of grocery business is about 7.5 times. It's $400 billion, 7.5 times of the online food delivery. Whereas the online grocery penetration currently is only and only 1%. So that's again a long runway which companies are able to see there. E-commerce, primarily Nykaa, I'm talking about, is basically your beauty, personal care, and fashion segment. The key about this thing, they are aggregators. Multiple brands coming on to a common platform. These brands are seeing this platform. Multiple brands are seeing this platform as a focused channel to do their advertising, focused advertising, and of course, saving on costs while advertising. And so with that, so many of brands see that as the biggest advantage, coming onto an empaneling onto this. And for these e-commerce companies also, if you see, right now the penetration of beauty and personal care products is higher. Fashion segment is smaller right now, but that's the one where the surprise earnings are expected to come in, and the runway or the pie is expected to grow. Again, the thing is that even the consumers have adopted to this e-commerce very well, whether it is all kinds of population across. And they've been very quick to adopt this. Of course, internet penetration, access to internet, um, and the growth of the drivers, which we saw, the data usage and smartphone users and everything is there. So that's for the consumer side. But at the same time, even these companies and the merchants have been very quick to adopt the digital ways to sell their wares. And such a large pie of such a large stack of brands being available on website, that's the biggest thing, which the merchants are seeing in their case. So it's being adopted fast by both. And if you see, in 2020, the access to internet vis-a-vis now 2025 expected, that percentage of online consumers is increasing. And online shoppers, currently at 12% in 2020, is expected to double and go up to 26% in 2025. Smartphone users, that's a driver from 36% to 55%. So these are all things which are helping. And if you see the market size of the beauty and personal care, in 2016 was about 14 billion rupees, now gone up to 91 billion rupees, and percentage of overall market share. So the online beauty and personal care market as a percentage of overall market has increased from 2% to 8%. So that's the growth rate that we are seeing. So much of these e-commerce and food tech and quick commerce growth rates you will find in the range of 30 to 45% over the next 5 years. That's the broader range that we are talking about. And again, as we saw in the food out of home food consumption and online food delivery, what was the market share for China and US? Likewise, if you see in the online BPC or beauty and personal care, China and US again are at more than 30% and more than 20%. So if India from that perspective definitely has a runway available there. That was the BPC segment. Fashion segment also for Nykaa right now it's small. It's just 1.5%, and that's the growth that the company is seeing there. But overall, if you see, the percentage of online fashion as a percentage of the overall market is a good 12%, and the market size is 450 billion rupees. Again, India is smaller vis-a-vis the China and US markets, where the online fashion market is already again more than 30%. And the reasons remain the same: quicker and better adoption, and digital maturity of consumers, tier 2 cities expansion, convenience to consumers, and everything. Fintech. Now, fintech here is, uh, because standalone payment aggregators are not someone, so they have done a good job in terms of aggregating or bringing together a lot of customers and merchants on their platforms. But UPI is something which is there. It's a universal presence across, and that's why standalone payment wallets are not the ones which have kind of picked up. The way to monetize the presence of customers and merchants on these platforms is by cross-selling a lot of other products and by digital lending. But digital lending also, you have some challenges in terms of scaling up, because the balance sheet owners still remain the banks. But as the space evolves, you will have many more changes coming in, and you will have these these platforms becoming balance sheet owners as well, and scaling up on lending. Plus, these platforms are very good providers of UI and UX, to the consumers, and these platforms can actually gather a lot of customer behavior and credit history of the clients customers, and provide that to a lot of other platforms, e-commerce platforms or something. And these are the benefits which can come in from a fintech space. And as more listings happen, we will see. But UPI, without doubt, is the main, it's actually shaken up the business for a lot of standalone payment model business. On the other hand, UPI as a enabler has helped a lot of other spaces like your food tech. Imagine online food delivery, and you have a UPI for a payment mechanism. It's a double dhamaka kind of a stuff, because you have everything then being digital, even payments, so it's basically you have a leverage in terms of online food delivery, and then you have another leverage in terms of the payment convenience which UPI offers. And the customer and merchant ecosystems which are there, as I mentioned, yes, they will be monetizing. The best way they are monetizing is by digital lending, consumer lending, and cross-selling other products. Super app, I'm sure you would have heard about Tata Neo, and there are a lot of other super apps which are in discussion. So those, these platforms can actually supply a lot of market intelligence to the super apps. Buying behavior, cash flows, bill payments, history, credit history, and everything. Healthcare segment, yes, there are multiple sub-segments to this healthcare segment. You have e-pharma, you have e-consultation, e-diagnostics, e-OTC. So right now, from the profit pool perspective, as well as from the overall pie perspective, e-pharma and e-OTC form a larger share. E-consultation diagnostics also contribute well, of course, up to 10%, which is a reasonable share. But e-pharma or e-OTC are very, very, they are the larger, they hold the larger pie in, they hold the larger share in that pie, in the health tech pie. And even if you were to assume that some bit of COVID impact were to recede, you would still have a lot of health care, the journey of the patient journey being still going online, or being strewn by health tech, because people have realized the importance. Doctors are able to reach to a much wider space, and there's a lot of convenience which is there in terms of online or e-pharma as well. E-pharma is the benefits which the e-commerce enjoys are also being enjoyed by e-pharma equally. So from that perspective, in fact, there are hospitals which are completely going online in terms of your bookings, consultation, e-consultations, online bookings, e-diagnostics, providing the medicines online, and of course, consulting online, everything online. So this space will see some more action in terms of reflecting in the market space or listings, and hopefully would get added. EdTech, the likes of Byju's and Upgrad and Unacademy, those are the things. They have their own spaces. It's basically anytime, anywhere learning, and gamification, making the learning more interesting. And then they have their own spaces. Some of them are higher education skilling, some of them are basic skilling, some of them are just preparing for some entrance exams. Some of them are casual learning, so they have their own spaces. But the benefits, of course, the thread of benefits is common. And the growth, as we are seeing from 2020, the expected growth right up to 2025 is a good 40% CAGR. So as I said, in all these tech areas, health tech, food tech, commerce, e-commerce, the next 5 year CAGR is expected to be about 35 to 40%, or 30 to 45%, depending on what we are talking about. This is just a quick, synopsis of all the spaces where digital ETF or this digital index wants to be. Very quick coverage of what is an ETF. Before that, even the myth that indices don't change because they are passive, they don't change. No. If you see the difference, if you see how the index or the constituents or the companies which were there in Sensex in 1980 and 2021, you will realize only a lot of changes have happened. Out of the 30 companies, only 7 continue. From 1980, only 7 companies continue in 2021. And there have been 23 editions, and out of the 23 editions, obviously, multiple did not even exist in 1980. If you talk about sectors, the sectors which we talk about, so enthusiastically, like your banks and finance and IT software, they were not present at all in 1980. But come 2021, you have 6 companies from the banks, you have 6 banks, you have 3 finance companies, and you have 4 IT software companies in 2021. So yes, on a daily basis, it's passive. But the larger point is, if you step back and look over a period, the indices do represent the economy, and they undergo a lot of change with their reconstitution and rebalancing method, which is inbuilt into the methodology. It's just that the methodology has been made rule based and it's set predefined. Rather than I would like to cover this thing first. So what is the difference between an active fund manager and a passive fund or a fund manager? What happens is, in an active fund, you see the fund manager uses his discretion, his judgment, and he builds a portfolio ground up. The larger criterias are, of course, the same for the lens which he uses, the fundamental lens which he uses to create a portfolio. But there are some discretion, some judgments which he uses for different stocks for different points in time, to include them, because he's taking a call on the management, he's taking a call on certain things, and he's ready to take a non-consensus call today that, okay, the larger market is not agreeing to this company's earnings growth rate, which is supposed to come 2 quarters down the line. But today, I am convinced as a fund manager, and I would want to place my decision on this and take that company, or take exposure to that company. So that's the kind of on the spot, in the moment decision and judgment which a fund manager uses, and creates a bottom up portfolio, sometimes uses top down also. So that's how. In case of passive portfolio, the rules are set, the methodology is predefined, and the passive portfolio, the methodology is rigid about top 2 to 3 rules. However, this top 2 to 3 rules, it gives a lot of simplicity and consistency in terms of portfolio creation. So there is no active versus passive, like there is no homeopathy versus allopathy. These are 2 parallel philosophies, medicine philosophies, which people take to. Similarly, these active and passive are 2 separate philosophies, investment philosophies, which exist, and it's good to diversify amongst both. Just a very basic example of how a passive thing works. Now, the idea is, and it's just to connect to what passive actually means. If the idea and the objective is to go and enjoy the evening, you could just team up. You don't want to spend too much time deciding what to wear. You can just team up a nice white shirt, or a white party wear, party shirt, and a nice bottom, and then you are done for the party. Finally, you're going to just enjoy the evening, rather than indulging yourself into deciding the flamboyant theme and what to wear, and match the accessories, and you want to save on the cost and time. Both people are going to go and enjoy the party, which is the objective, enjoy the evening. However, one person takes it reduces the decision making to something simple and more classic, and the other one is wanting to go elaborate. So, but both are, it's not right or wrong. It's just to give you a peek into what simplified decision making means. So it's basically just setting the rules and then playing the rules, and every quarter, and then seeing how the portfolio changes. Just a quick one on ETFs versus index funds. So index funds or FOF, that's a fund format basically. So our this fund of fund will be going and buying units of the ETF, and ETFs are nothing but something which trades like stocks. The portfolio is passive. So basically, a stock which exists on the exchange, here a basket of stocks which is capturing the digital theme is something which will be sitting on the exchange, and the investor can buy the full basket as is, the digital basket as is. It's, this portfolio is a portfolio of 30 stocks, and the price is real time. The price available for an ETF is real time, as compared to the other funds which are end of day. For an ETF, it is real time. Again, for fund of fund, because it will be on the fund platform, it will be a end of day pricing. And the primary reason for ETFs and fund of fund, the costs are very low as compared to your active funds. And ETFs are compulsorily to be held in demat form. A fund of fund obviously is a fund format, so it can be held as good as your as good as you hold your mutual funds, the other mutual funds. And the portfolio of ETF will be available daily. So obviously the fund of fund portfolio is also available daily. Whereas and any which ways, it is it is an index. It is an index, so it is known because it is constructed along with the index provider and index constructor. So the portfolio is known beforehand, like how we know the portfolio of the Digital India Fund beforehand. And I will just come to the portfolio currently. So this is a portfolio. This is the 4 editions which I mentioned at the start, Zomato, Nykaa, and the likes will get added soon. It will only get added tomorrow. However, as you can see, it is the portfolio is known beforehand. Now, this portfolio has a good mix of IT or the digital enablers, the IT services and the cloud transformation, which I spoke of, the bellwether companies, the steady compounding companies, which are into this primarily the business of cloud migration and cloud transformation, which is the mainstay, as well as the digital change agents which are there, which is the space we spoke about all through, which is the food tech and the quick commerce, the grocery delivery, the online food delivery, the e-commerce, which is the likes of Nykaa, and all those things. How do we construct this index, and what is so passive about it? NSE 500 is the universe taken. Within that universe, there is a segmentation done of the basic industries. Only those basic industries which are catering to, or which are focusing, which have companies which are focusing on the digital technology will be picked up. So IT services, robotics, all those companies which are into IT services, robotics, IoT, which is your Internet of Things, which basically connects 2 devices. Internet of Things is nothing which connects 2 devices, and those 2 devices can talk to each other. For example, your fridge, if it has gone low on talking a particular thing, it will beep and it will give an intimation to maybe an app on your phone, and then you will order. Or all your electric system is kind of consolidated on one platform and one instrument. So that's basically an IoT, where digital devices talk to each other. So all the companies which are focusing on digital technologies, IT services, these digital change agents, and these companies, whichever basic industries they are sitting into, those basic industries and the companies along with them will be chosen. So from NSE 500 universe, a digital and IT universe will get created. On this digital and IT universe, for example, let's say from these 500 companies, a digital and IT universe of 100 companies comes out and pops out because of the basic industry rule that is run. A 100 company universe comes out. On that universe, a top 30 companies by market capitalization, free float market capitalization, they are selected. So that's the second rule, that top 30 companies by market capitalization, free float market capitalization is selected. And then if required, to include or exclude a company, let's say some companies there which is huge on digital revenues, is the revenue of that company is big in term and is coming from digital doings, but is not included, but that basic industry is not included. So we can use some artificial intelligence and web search to include those kind of companies. That is also inbuilt into the methodology, but that's of course only if the digital universe has a company which we think is a digitally inclined company, but it is not coming it into this 100 companies. Only then we go and use this third rule. And then the next rule which we apply, we say that we will be capping the segment weight to 50%, which means in the current IT index or the active funds, what happens is the likes of your Infosys and TCS are, the weights are 28 and 30% because those companies are large. But here in this portfolio, we are saying that as of now, we want to cap this IT services and cloud transformation to 50% and leave the balance 50% to the other digital change agents. Because of this capping, our weights for Infosys and TCS, as you can see here, is coming to 8 and 7.5%. Now, this is a mid-month portfolio, and that's why you see. Otherwise, the other rule, the next rule which we have applied is stock weights are being capped at 7.5%. Because we do this, a lot of emerging companies start getting weights and allocations. The portfolio is not there, but if you see the tentative portfolio which we got from NSE yesterday, across these 4 stocks of Zomato, Nykaa, Policy Bazaar and Paytm, we have got an overall allocation of 13%, which obviously would not be possible if you don't apply these rules and create an index like this. The idea is to capture the new age digital change agents or the new age digital companies, and also keep having the IT services companies as steady compounders. But alpha creators we want to add. Unless and until we apply these rules, we won't be able to add those companies by the passive route. And the last point I would like to mention here is IPO inclusion now will be happening. So all the IPOs which have a 1 month of trading history will get screened, and they will get screened for eligibility. Of course, if they're eligible, they will make their way into the digital and IT universe, and from there they could make their way into the digital index also. But previously it was 3 months of listing. Now we've made this along with NSE. We've made this as 1 month of trading history, and eligible IPOs, at least they would be screened, and eligible IPOs would come in. So as you can see, just to sum up, the Tata Digital India Fund has more of these bellwether core portfolio mega IT companies, and very few, hardly any of these satellite companies or the emerging technology companies. Even if we take some exposures here, like we've done cybersecurity, etc., that would be about 5 to 8%. Won't go beyond that, because the objective of this company, of this fund, is steady compounders, and obviously to utilize or to ride that IT growth, steady compounding growth rate. But here the idea is to have a good mix of digital bellwether companies, the IT bellwether companies, as well as the new age digital change agents. And that's why we've constructed in this manner. In fact, there is a piece of digital concept which we've come in, where we are saying that through our website, there's a link. You can come in and let's say you have X amount of rupees, or let's say you have 100 rupees. You can allocate 50 rupees to a active digital fund, which is more into the IT bellwether companies or steady compounders. So active fund exposure through steady compounders, and the balance 50 you can go do a passive fund exposure through new age digital agents also. So that's a good kind of a diversification, active, passive, as well as steady compounders and alpha creators. So that's a proposition which we want to see. This of course is the are the dates for the ETF, but the FOF continues to be till 20 continues to be till 8th of April, which is going on, and the fund of fund is going in buying ETF units, and this ETF is the portfolio of these companies which I just mentioned, and the final portfolio we'll be receiving today, because that's the reconstitution date. So we'll be receiving it. So I'll stop here, and if there are any questions, then obviously we can take them.
Thanks, Shaily. I think it was a very detailed discussion, and you also took some of the sectoral, things to showcase what kind of companies this index would be taking.
Yeah.
And we've got few questions. I think your last slide, which you were talking, the difference between digital fund,
Yes,
the active one, and this. So there is a question which says, should I consider this NFO for investing in digital space, or should I continue to invest in Tata Digital Fund since my returns are good in digital fund? And curious to know the difference. I think you explained the difference.
yes. What I will do is, in fact, I want to, while I answer this question, I just want to, yeah. So digital fund, you should continue. I mean, this is by no way saying, as I said, it's a diversification. There, it's an active bet. And there it's an active bet. Here it's a passive route. Again, as I said, there is no active versus passive. The idea here is to be able to capture the alpha creators through and that's the entire reason. See, it's an evolving space. So in IT fund, in the digital fund, these are bellwether companies which are there, which are into this business of primarily a cloud transformation, which is moving the wares. Like a warehouse is there, a cloud is a warehouse, and you're moving the wares. And these companies have gotten good in terms of integration of that entire journey. That is set. That has got a growth coming in, and for the next 5 years also, because of the era which we are in. So that continues. Some of these companies like TCS Infosys also gotten into a lot of IoT, artificial intelligence, robotics, and providing the backend to some of these e-commerce and quick commerce companies. So they are there, but they are primarily steady compounders, of their earnings and obviously the stock price accordingly. Here, the idea is right now, if you see the share of new age digital companies as we define the food tech and those parts is about 25%, with 13% now getting added tomorrow, as I said. So over a period, this will grow, but the share of alpha creators here is expected to go up here, and that would be good 20%, good 50% in this index. And because it's an evolving space, and we are still seeing what's happening, it's good to have a passive route. So you have a good diversification. So in short, I would say that between active, passive, and steady compounders and alpha creators, you should diversify. Add to so whatever digital you have, probably take alongside, take an exposure to. It is not IT.
Complementary. Both are
complementary.
complementary.
You can't just redeem this and come in here for sure. No. And this is the difference, as I was highlighting, the because IT index is kind of representative of what the IT the digital fund would be. So you have 10 constituents there. Here you have 30 constituents. The percentage of weight in top 5 stocks is good 80%, and top 2 stocks, it is Infosys and TCS, is 56%, whereas the percentage of weight in top 2 stocks is 17% in case of the digital index. So the idea, and because of those methodology, which I say, the capping, the 7.5% stock capping and the 50% IT services capping, you get a lot of weight allocation to the emerging companies.
Emerging.
Yes,
Yeah.
yes.
So you also mentioned about IPO. So there is a question which says, can this fund invest in IPOs? So post IPO only you can invest here, right?
Post IPO, only
That,
post IPO.
that's what mutual funds can do anyway.
Yes, yes. Post IPO eligibility criteria as per the methodology will remain. The only thing change which we recommended, and now if you see that has been made for all the indices. For all the indices, NSE has gone ahead and released a circular saying that any IPOs instead of 3 months of trading history, 1 month of trading history will be considered for the eligibility.
Okay. For all the funds.
For all the indices. Now,
okay.
effective tomorrow.
One last question, again, which is common, which comes, should we look at SIP route for this fund? Or at this time, since we have seen a lot of correction in some of the digital names, is it right time to put bulk money?
So lump sum in the fund of fund, lump sum can be looked at. Because as Gaurav also mentioned, the high growth companies and any which ways overall broader market correction also has let it come to 17-18 PE, which is your equivalent to your historic average or 10-year average. Even a 1-year forward PE average is at about 18%. So we are at a fair market valuation, probably a little less than that. From that perspective, you should consider lump sum. However, because the incomes are regular, SIP building a SIP portfolio is not, because your incomes are regular. So in fact, I would just leave one thought that if the starting point is out of your income, you are setting aside 20% of your income for savings and investment, which is the broader rule. And within that 20%, assuming you are a 100% equity investor, I'm not going into the hybrid model. And within that 100% equity, my assumption is, and the ideal way to do would be to hold 8 to 10 funds. Within that 8 to 10 funds, if you have a thematic fund, this should have a place into that. That's the way I would put it, overall. So you can do your core portfolio, satellite portfolio, and all that. And within that 8 to 10 funds, whatever is the thematic space, which is a satellite space, you should allocate some money to this theme. That's the idea.
Sure. Shaily, thanks a lot for this session for our viewers. And I think the session was quite nice in terms of largely the difference between the active funds and how the new index is created and what is the difference between the two funds. So I'm sure a lot of our viewers would have got a lot of clarity and they would like to invest into this fund. So thanks a lot for sharing all your views on the fund as well as the sector.
Thank you. Totally my pleasure, Gaurav. And thank you to the entire audience also for listening in. Thank you.
Yeah. So thanks everyone for joining, and please explore our Moneyfy app, and you can download Moneyfy from Play Store and App Store, and also subscribe to our YouTube channel for more such insightful discussions. So thanks, Shaily. Thanks a lot.
Thank you. Thanks once again. My pleasure.